Hi, welcome to my YouTube channel once again. Today we'll be talking about the double entry principle. Now, in my previous video, I've mentioned what double entry principle entails. It states that all transactions must be recorded in two accounts. One account is debited and another is credited. Now, the crux of it is that for every debit entry, there must be a corresponding credit entry and vice versa. Debit the receiver, credit the giver. In layman's term, if you make a business transaction, it involves two accounts. While one account is giving out, the other account is receiving. Now, it states that the account which is receiving is debited and the account which is giving out is credited. So the principle of double entry states that for every credit entry, there must be a corresponding debit entry, and for every debit entry, there must be a corresponding credit entry. Now, I'm going to be giving a lot of examples to illustrate the principle of double entry. Now, let's start with example 1. He said, started business with 20,000 naira in the bank. First things first, what are the two accounts involved here? For example, Emeka started business with 20,000 naira in the bank. Now, the money you use in starting business is called what? It's called capital account. And you started with what? In the bank. So we have bank account. So for these two accounts, which is giving out and which is receiving? You started business with 20,000 naira in the bank. It means the bank account is receiving. So bank is debited. Capital account is giving out. So capital account is credited. Now we have illustration 2. Cash purchases of 10,000 naira. You went to the market to purchase goods and you paid with cash. What are the two accounts involved here? We have cash account and we have purchase account. So which should be debited and which should be credited? We have cash account. We have purchases account. So you went to the market to purchase goods of 10,000 naira. You paid using cash. It means your cash went out, but you purchased goods. So your goods purchases received. So the account which is giving out, which is cash, is credited, and the account which is receiving, which is purchases, is debited. Illustration 3. Sold goods of 50,000 naira to Mayowa. You made sales of 50,000 naira to Mayowa. What are the two accounts here? When you sell goods, we call it sales accounts. We have sales account, and Mayowa. Because there is it was not specifically mentioned if it is cash or check. So we have Mayowa. So which is giving and which is receiving? When you sell goods, your sales are depleting. So sales account is giving, credited. Mayowa is receiving, debited. Illustration 4. Sold goods of 40,000 naira and received check. Whenever you see check in account, it's the same thing as what? Bank. Because when you have a check, you go to bank to collect your money. So you sold goods for 40,000 naira. We have two accounts here: sales, bank. So we have bank account, and we have sales account. So in this case, which is giving out and which is receiving? When you sell goods, your goods are going out, but the bank account is receiving. So bank is debited and sales is credited. So I'm going to be giving a host of extra illustrations to also explain the principle of double entry. So let's look at further illustrations. So we have bought furniture for cash of 10,000 naira. What are the two accounts involved here? Furniture account and cash. So we have furniture account. we have cash account. So which account is receiving and which account is giving out? So when you go to the market and purchase furniture, you paid using cash. You paid using cash rather. Cash is going out, but you are receiving furniture. So you debit furniture account, you credit cash account. Next illustration, withdrew money 30,000 naira from bank for private use. Now you went to the bank and you withdrew money. Two accounts are involved. We have bank account, we have drawings account. So bank is credited, drawings account is debited, because bank is giving out, but you now have drawings account, which you are more like, if it was not specifically stated that the exact purpose for which the money was used. Let's say, for example, withdrew money 30,000 naira from bank. We already established that bank is giving out, so we'll credit bank account. Then we are going to debiting cash. So we're going to assume that your cash account is increasing. Of course, when you withdraw from the bank, you are getting cash. But because it is specifically stated that it is for private use, we are going to be it's directly hitting your drawings. That's what it's called, because when you go to withdraw money for your personal use, it is called drawings. Next example, we paid Chemistruct Limited by check 50,000 naira. There are two accounts here. We have Chemistruct Limited and we have bank account, because remember I said whenever we talk about check, we are referring to bank. So let's talk about this. When you pay Chemistruct Limited by check, bank is going out, of course, so you credit bank and you debit Chemistruct Limited, because Chemistruct is what? Receiving. If it was the other way around, Chemistruct Limited paid us by check, of course it will be reversal. You credit Chemistruct, you debit bank. Now, paid wages of 200,000 naira cash. The traditional method of opening T account was like this. So let me use it in this final example. So we have wages account, we have cash account. So in accounting, it is very important. As I've illustrated in my last video, the left hand side is always called the debit side and the right hand side is called the credit side. So we have debit, we have credit. So when you are posting, it is very important that, you put your currency. These are some of the things that are very important in Naira. So when you pay wages 200,000 naira cash, wages account is receiving. So you debit, let's put a date of transaction in this. Let's say November 1, paid wages 200,000. We come here November 1, or rather, come here November 1. We paid wages 200,000. We write cash account 200,000. Then cash is given out. So come here November 1, wages account 200,000. So you can just illustrate these other examples. The previous example I've made using the traditional T accounting accounting diagram. Let's call it that way. Accounting table. So the left hand side is always the debit side, then the right hand side is called the credit side. So that is what the principle of double entry is saying, that for every debit entry, when one account is hitting the debit side, another account must for that same amount must be hitting the credit side, either one or two. So at the end of the day, it balances itself. There's a debit leg and there's a credit leg, which is for every debit entry, there must be a corresponding credit entry and vice versa. So that is what double entry principle is all about. So if you have your personal textbook, Remember, this is accounting for beginners. Of course, you can solve many other illustrations. If you have any question, please feel free to ask me in the description link.